Today we are talking about Activision. Now, this company's been pretty popular since last year. It's been brought up by Microsoft to potentially be acquired by them. Now, the FTC is kind of stepping in to say, oh, hold on. We might be blocking this deal because Google's been making a fuss about it. Sony's been making a fuss about it. Nvidia's been making a fuss about it. All this drama surrounding this company. But here's the thing, folks. Let's say this deal doesn't go through. What is this company worth? What is this company to you, a value investor? That's what we're going to do today on the video. We're going to run through the numbers of Activision so you have an idea where this company stands and what you should be paying for it, most importantly. I'm going to load this up here in the stock spec software. With Activision, we are ranking this company in 7 out of 10. Not a bad score. If you're new to the channel, this software dissects every company you can possibly think of and takes a look at their company's financial statements so you don't have to go through all the different lines. Software does it for you in an instant. 7 out of 10 is a pretty decent score. They're only getting points deducted in 3 different categories, guys. One of those categories, one is their price to earnings ratio on a 5-year average, sitting at 60.57. That's somewhat of a premium. We don't want to find companies that have such a high price earnings ratio. Ideally, we are looking for companies that have a price earnings ratio of 22.5 and lower. You don't want to be overpaying for someone's earnings. No one has time for any of that. Their return on equity average is getting knocked as well. We want to find companies that have a return on equity sitting above 15%. 15% or higher is nice and healthy. Currently, it's sitting at 12.11 on average, and the trailing 12 months, not looking too great, sitting at 9.24, so a small dip in the return on equity, so not too great. As well as they have been diluting you. So they've been upping their share count by 1.51% over the last 5 years. Not a huge increase, but an increase nonetheless. If a company's buying back shares, that's what we want to see. They have a low debt to equity, which I love to see. They have a high current ratio, sitting at 5.76. That is huge. We want to find companies that have a current ratio of 1.5 and higher. Their EPS is up, their revenue growth is up, the free cash flow growth is up, and the net income growth is up. And their return on invested capital is sitting at 11.87%. That is phenomenal. In comparison, though, their trailing 12 months return on invested capital is 8.50. Not the worst, not the best. However, it's still decently high, all things considered. Now, if you are invested into Activision or looking to invest into this company, they do pay dividends, and that comes out to be paid out to be $365 million. Is this dividend safe or not? Well, take a look at this, guys. Their average free cash flow comes out to be $2 billion on average, meaning they can easily cover those dividends. So wipe the sweat off your forehead. You're going to be all right. Almond Z score is currently sitting at 7.04. That's a pretty high number. That just indicates that they are incredibly safe from bankruptcy. But look, here's the thing, folks. Why does Microsoft want to get Activision? Well, you possibly know this answer. They make phenomenal games that are engaging. They have a large following. They make games like Call of Duty, which you've definitely heard of, and as well as World of Warcraft, which these games alone bring in a huge amount of people to play them. They know how to bring in customers. They know how to keep getting people back to playing their games. And look, you talk to someone that grew up with the games like myself, they are a lot of fun. Without that spiel put off to the side, what is this company really worth? We're going to go into the price analysis section of this software, and I'm going to do a 10-year analysis. Guys, if you're enjoying the video so far, hit that like button and subscribe button. It means a lot to me, it means a lot to the channel. The software I'm using, 7-day free trial. You can use it as much as you want, cancel whenever you want, but I guarantee you'll probably stick around knowing the fact that you can get the intrinsic value of any company within an instant. Look, we're not even 10 minutes into this video, and you already know that on average, you should be paying $59 for this company. Currently, it's at $76. I've done other analysis videos on this company in the past, and luckily the stock price has pretty much been trading parallel. So this is what you should be paying ideally for this business. Now, granted, this is using some pretty conservative revenue growth numbers going forward. It's hovering of what they've currently done over the last little while. Now, the gaming industry is a massive industry that's going to continue to grow, and I can't see this company to slow down. With that in mind, that is my margin of safety, along with the profit margin, free cash flow margin taking a little bit of a haircut, and putting the price to free cash flow and price to earnings ratio in a much more healthier range. Like I said, 60.57 is a massive premium for a company like this. So I stuck below 22.5 along with a 13% return, because obviously you want to be making more than what the S&P 500 is giving you. It comes out to be 59.8. So what is the end of this analysis going to be? Essentially, wait for the stock price to come down. And I guarantee you, folks, if this deal does not go through, this stock price will start to drop. I wouldn't be surprised, because people are going to be getting out of panic. People got into this company because Warren Buffett got into it, because of the fact that Microsoft wants to buy this business. Now, here's the other flip side. If hypothetically it does go through, the arbitrage play is still there. That means that you will be getting $90 a share for this business because of Microsoft's acquisition. So it's a little bit of a tough ball to try to gauge and how to catch it. It's a curveball, really. So what do you think? Personally, as time goes on, I really don't think this deal is going to go through. I really don't think so. I think there's going to be a lot of pushback. I think it's going to be squashed. I mean, it looks like it pretty much is going to get squashed. So I'm going to potentially just wait for this company to go lower in price before I potentially even jump in. I think it's a pretty solid business. As I said, it's a financially strong company. You are paying a premium you are paying a premium for some of those earnings. However, at the right price, that price to earnings ratio can be ignored. If that's the one line I might be able to blur, because the free cash flow is up, revenue growth is up, net income is up by huge amounts. Anyways, folks, that's the video. Let me know what you think in the comment section below. I will see you in the next one. Thank you so much for watching.